You're about to join into the world of systematic market cycles. Learn the most dependable and consistent, yet often overlooked investment strategy. Welcome to the Technical Intrinsic Value Podcast.
So picture this. It's 2015.
Okay.
And if you looked at the headline earnings for the companies in the S&P 500.
Right. The big guys.
Yeah, exactly. The numbers they just blasted out in all their press releases. The numbers that, totally drove the financial news cycle.
The ones everyone was trading on.
Exactly. Those companies collectively reported $804.2 billion in net income.
Massive.
Right. It was a banner year. I mean, everyone's popping champagne.
Yeah.
But, and this is the crazy part, if you bypassed the press releases and actually read the strictly audited, legally binding regulatory documents.
The ones they actually have to file with the government?
Yes, the exact same companies. Their net income was actually only $562.3 billion.
Wow.
Yeah, almost $250 billion.
Yeah.
$241.9 billion to be exact, just vanished into thin air.
Just poof, gone.
And it wasn't fraud. That's the wild part. It was completely legal. So today, we're going to find out exactly how they pulled that off.
Because it is, without a doubt, the most pervasive, legalized sleight of hand in modern financial markets. I mean, it happens every single quarter.
And understanding that sleight of hand is exactly why you are here. Welcome to the Technical Intrinsic Value Podcast. I am your host, and before we plunge into the deep end of today's deep dive, we have some mandatory but highly exciting housekeeping to get through.
Always got to do the housekeeping.
You know it. So first, I need to explicitly state that all the analysis we are about to unpack today, it translates the specific proprietary view of Nicolau Primavera Carvalho.
Right.
He is the creator of the proprietary technical intrinsic value model.
Which a lot of folks just refer to as the TIV model.
Exactly, the TIV model. And for those of you out there who really want to master these concepts rather than just kind of, skimming the surface.
Yeah, if you actually want to do the work.
Right. Nicolau Primavera Carvalho is the author of the foundational book, Technical Intrinsic Value, and you can grab that right now on Amazon.
It's honestly essential reading. If you want to understand market mechanics at a real structural level, you need that book.
Absolutely. Just go to Amazon, search for Technical Intrinsic Value. Furthermore, and this is huge, if you are a frustrated intermediate investor looking to truly level up your analytical skills, I urgently direct you to the Technical Intrinsic Value program.
Yeah, this isn't just like another generic video course you buy and forget about.
No, not at all. It is an intensive live coaching program strictly limited to a maximum of 5 students.
Just 5.
At a time, yeah. It literally does not get more hands-on or personalized than that.
Yeah.
You're live with the creator. You need to join the waiting list right now at www.technicalintrinsicvalue.com.
Seriously, do not miss that opportunity. Being in a room of 5, working directly with the creator of the framework, that's where the actual breakthroughs in capital allocation happen.
100%. Okay, housekeeping done. Let's unpack the core theme for today's deep dive. We're talking about financial statements. GAAP versus non-GAAP.
The bifurcated ledger.
Yes. And we are speaking directly to you, the intermediate investor.
Yeah.
You're out there, you're putting in the work, you understand standard fundamental analysis.
You know how to read a chart.
Right. You know what a PE ratio is.
Yeah.
You know how to discount cash flows. But you're sitting there looking at your portfolio and you just feel like a crucial piece of the puzzle is missing.
Yeah, because you're seeing stocks react to earnings reports in ways that seem totally divorced from reality.
Exactly.
Yeah.
A company announces this massive loss and the stock rockets up 15%.
Yeah.
Or, they post record profits and the stock just craters.
Right. And that feeling of absolute disconnect, that cognitive dissonance you get when the headlines don't match the price action, it's incredibly common.
It's maddening.
It is. And it almost always stems from a fundamental misunderstanding of the reporting framework itself. Basically, you're reading the wrong map.
I was thinking about how to visualize this for the listener.
Mm-hmm.
Relying just on top-line earnings numbers without understanding the underlying accounting framework. Mm-hmm. It's basically like trying to drive a car while only looking at the speedometer and completely ignoring the check engine light.
That is a fantastic analogy.
Right, because management, they're the ones pointing at the speedometer saying, look how fast we're going, we're doing 80.
Ignore the smoke. Coming from the hood.
Exactly.
Yep.
That smoke is just a one-time atmospheric event. It doesn't impact our core driving efficiency.
Yeah, they just put a piece of black tape right over the check engine light. So our mission today is to give you a deeply analytical, objective framework so you can read both. You need the speedometer, but you really need to understand the check engine light.
We want to help you cut through the market noise, right? Spot those structural realities that the rest of the crowd is just totally ignoring so you can maintain a long-term, sustainable wealth-building mindset.
So let's start at the foundation, the logical foundation.
Break down the mechanics for me. Because if I log into my brokerage account right now, I usually just see one number for earnings per share.
Right. The app makes it look so simple, but the reality is the bifurcated ledger. Public companies in the U.S. essentially speak two completely different financial languages at the exact same time.
Two ledgers.
Exactly. On one side, you have GAAP, generally accepted accounting principles. This is the highly standardized, incredibly conservative, legally mandated baseline.
Now, who actually writes this rule book? Is it just the government dictating things?
It's actually a combination. The rules themselves are formulated by an independent private sector group called the Financial Accounting Standards Board, the FAS.
Okay.
But the enforcement, the actual mandate that public companies have to use these rules for their filings, that comes directly from a government regulator.
The SEC.
Yep, the Securities and Exchange Commission. So FASB writes the rules, and the SEC acts as the police force ensuring companies follow them.
So what's the fundamental philosophy of GAAP then? Because I know a lot of retail investors find GAAP to be, incredibly confusing or noisy.
The primary philosophy is comparability and conservatism. GAAP includes absolutely everything. It's designed so you can take a tech company's 2025 results and compare them to a manufacturing company's 2025 results, or compare that same tech company to its own results from 10 years ago, using a perfectly standardized ruler.
It's objective.
Completely objective. GAAP doesn't care about management's feelings. It captures all revenues, all expenses, whether they're recurring, non-recurring, cash, non-cash. Everything from raw materials to the depreciation of the breakroom microwave is strictly accounted for.
And it's audited by a third party.
Exactly. Independent verification.
Okay, so GAAP is the unvarnished truth. It's the check engine light. But then we have the other side of the ledger, non-GAAP.
Right. Non-GAAP measures, officially they're called alternative performance measures. And here is the critical distinction for every investor listening.
This is the key.
Non-GAAP metrics are determined entirely at management's discretion. Yes. They are bespoke. They're custom-made. They do not follow the strict objective guidelines of the FASB. Companies put these out in their press releases, arguing that they highlight, quote-unquote, core operational efficiency.
By stripping out the bad stuff.
Basically, they exclude irregular, non-cash, or one-time items. Management is trying to show you what the business looks like under normal circumstances.
Okay, let me play devil's advocate here for a second. Because management would argue that GAAP is archaic.
I do argue that.
Right. They say GAAP includes all these useless paper losses and historical accounting quirks that don't actually tell me if the business can pay its bills next month. Like if a hurricane destroys a warehouse.
Huge GAAP hit.
Massive hit. But it's not going to happen every single quarter. So shouldn't management strip that out so I can see if their actual day-to-day business model is working? Aren't they kind of right?
Look, there is a grain of truth to that argument, which is exactly what makes non-GAAP so seductive.
Right.
Accrual accounting under GAAP can definitely obscure the immediate cash-generating reality of a business. But the danger, the massive structural danger arises because management is inherently biased.
Of course they are. Their bonuses depend on it.
Exactly. Stock options, bonuses, just wanting to keep their jobs. They are incentivized to make the company look as profitable as humanly possible, so they're very quick to adjust away the cost of the hurricane.
But I bet they don't adjust away a one-time windfall gain.
Bingo. They almost never back out a random gain. It is selective filtering.
Yeah.
And the data proves this upward bias unequivocally. That statistic you opened with from 2015 is the perfect illustration. Aggregate GAAP net income for the S&P 500 was $562 billion. The non-GAAP was $804 billion.
That's a 43% inflation gap.
Across the 500 largest companies in America. And it's not just an American thing either. If you look at the UK market, studying the FTSE 100 from 2008 to 2014,
Okay.
the non-IFRS adjusted net income, IFRS being their version of GAAP,
Right.
it was higher than the reported net income in every single year of that study. Adjustments accounted for nearly 80 billion pounds in upward inflation.
Wow. Okay, so if the game is this tilted, If there's a 43% inflation gap and companies are just painting a pretty picture, why does anyone trust these numbers?
That's a great question.
I mean, why are institutional investors, the smart money, hedge funds, pension funds, why are they even looking at non-GAAP? Why don't they just exclusively use the audited GAAP numbers and throw the press releases in the trash?
Because of nuance. Institutional capital allocators do not take non-GAAP at face value. They don't just read the headline and smash the buy button like a retail investor might.
Okay.
There's a comprehensive survey by the CFA Institute, the gold standard for financial analysts. It reveals exactly how the pros operate. It shows that 96.5% of buy-side and sell-side professionals use GAAP as their unshakable foundational framework for valuation modeling.
96.5%. Virtually everyone uses GAAP.
Yes, it's the bedrock. But here's the kicker. 76% of those exact same professionals state that they still use non-GAAP metrics to augment their analysis.
Wait, so they are actively using both. They're looking at the check engine light and the speedometer simultaneously. Why?
Because they treat GAAP as the audited reality of historical transactions. But they use non-GAAP to understand management's perspective on future cash generation. Let's walk through a concrete example.
Let's do it.
Let's say you're analyzing a massive industrial manufacturer. In Q3, they decide to shut down this obsolete money-losing factory in Ohio.
Okay.
Taking that factory offline, paying severance to the workers, breaking equipment leases, all of that generates a massive one-time restructuring charge of, say, $500 million.
Right. And under the rules, that $500 million goes straight to the GAAP income statement. It completely destroys their net income for the quarter.
Exactly. Now, if you only look at GAAP, you see a business that is suddenly bleeding cash. And your financial model for the next 5 years will project them going bankrupt. But an institutional investor looks at that and says, okay, the $500 million hit is a real, undeniable expense. The money left the building.
You can't ignore it.
You can't. But they aren't going to shut down an Ohio factory every single quarter for the rest of eternity. The bleeding stops here. I need to know what the underlying cash generation of the remaining highly efficient factories looks like so I can forecast their free cash flow for next year.
Ah, I see.
So management releases a non-GAAP adjusted earnings metric that strips out that $500 million charge. For the institutional analyst, that well-constructed non-GAAP metric is a really useful starting point.
It isolates the engine.
Exactly. It helps them model the core business. So the professional uses non-GAAP to build forward-looking models, but they use GAAP to ensure the company actually survived the historical trauma.
Man, that is a massive paradigm shift for the intermediate investor. It's not about blindly trusting the adjusted number. It's about interrogating the bridge between the two.
Interrogating the bridge, yes.
But you know, this dual reporting system, it didn't just fall out of the sky. We didn't always have, 93% of the S&P 500 using these bespoke metrics.
Yeah.
How did this become the absolute standard?
To understand the modern reporting environment, you have to travel back in time to a period of absolute financial chaos. The late 1990s and the early 2000s.
Oh boy, the dot-com bubble.
The dot-com bubble.
Yeah.
That era was the crucible that forged our modern regulatory environment.
It really was the Wild West of accounting. I remember studying this. You had all these emerging internet companies going public, Pets.com, Webvan, eToys.
Yeah.
They had astronomical burn rates. They were just hemorrhaging cash, generating massive, terrifying GAAP operating losses.
Yeah.
And because they had literally zero actual profits to show investors, they just started inventing bespoke metrics out of thin air.
They absolutely did. They realized that under the strict scrutiny of GAAP, they looked exactly like what they were, failing businesses. So they just changed the conversation.
Yeah.
They started pointing investors away from the bottom line and toward these completely unregulated, unstructured, alternative views of performance.
They were telling people, hey, stop looking at our massive net losses. Look at our eyeballs.
Eyeballs.
Look at our page views. Look at our pro forma gross merchandise value. They're basically saying, hey, if we just ignore all of our massive expenses, our Super Bowl commercials, our server costs, our customer acquisition costs, we're actually highly profitable.
Precisely. They were weaponizing alternative metrics to mask severe, fatal financial instability. And for a while, the market bought it.
Hook, line, and sinker.
The retail crowd ate it up because the stock prices were going to the moon. But then the bubble burst. Trillions of dollars of wealth just evaporated. And right on the heels of the dot-com crash, we had the massive systemic corporate accounting frauds.
Enron, WorldCom.
Yes, where executives were literally going to federal prison for hiding debt and fabricating revenue. The regulatory bodies, specifically Congress and the SEC, realized that public markets were facing an existential crisis of confidence.
Investors had zero trust.
None. So in July 2002, Congress passed the Sarbanes-Oxley Act, commonly known as SOX.
A huge deal.
The most sweeping overhaul of financial regulation since the Great Depression. And buried within that massive piece of legislation was Section 401B, which explicitly ordered the SEC to regulate these wild non-GAAP disclosures to protect the public.
So the hammer finally came down.
Yeah.
And that congressional mandate is what led directly to the SEC creating Regulation G, right?
Correct. March 2003, the SEC officially codified Regulation G alongside a specific rule called Item 10E of Regulation SK.
Okay, let's unpack these, because these two mandates are the foundational pillars of everything we're discussing today.
Right. Let's start with Regulation G. It established a very basic but incredibly powerful requirement for all public communications. It mandated that any time a public company discloses a non-GAAP metric, it must simultaneously present the most directly comparable GAAP measure.
So they couldn't just shout record pro forma earnings into a vacuum anymore.
Exactly. They had to ground it. And even more importantly, Regulation G demanded a clear, quantitative reconciliation bridging the two figures.
The bridge.
You can't just throw out a magic adjusted number. You have to show the math. You have to provide a table that literally says, we started with X under GAAP, we added Y, we subtracted Z to arrive at our non-GAAP figure.
They forced them to show their work. Like a middle school algebra test.
Exactly like that. Now, that's Regulation G for general communications. But the source material puts a massive emphasis on Item 10E of Regulation SK.
Yeah, what makes 10E so specific? Why is it so critical for the formal filings like the 10K and the 10Q?
Item 10E is all about presentation, prominence, and preventing deception in the most heavily relied upon documents. It established strict boundaries. And the most famous rule within Item 10E is the prominence rule.
Prominence, okay.
It strictly prohibits companies from presenting their shiny, adjusted non-GAAP metrics with greater prominence than the audited GAAP figures.
Okay, give me a visual of what that actually means for a retail investor opening a press release.
So before Item 10E, a company could blast adjusted record profits of $5 a share in bold 24-point neon green font at the very top of page 1 of their earnings release.
Right. And then where was GAAP?
They would bury the actual GAAP net loss of $2 a share in microscopic 8-point font in footnote 14 on page 80.
That is just blatant visual manipulation.
Exactly. Item 10 made that illegal. If you put a non-GAAP number in the headline, the GAAP number must be right next to it in the exact same font size or larger. The GAAP figure must always be equal or more prominent.
That makes total sense. You can't vary the check engine light while shining a spotlight on the speedometer. Now, there's another part of Item 10E that the sources highlight, and it's a bit more technical.
Let's hear it.
It says the SEC expressly forbids presenting non-GAAP liquidity measures on a per-share basis.
Yes.
Why is a per-share liquidity rule so important? Why does the SEC care if they divide cash flow by the number of shares?
This is a phenomenal question, and understanding this protects you from a massive trap. The SEC bans per-share non-GAAP liquidity metrics because it prevents companies from using adjusted metrics as a deceptive proxy for distributable cash.
Distributable cash meaning the money they can actually hand back to me, the shareholder, as a dividend.
Precisely. Let's say a company creates a bespoke metric called adjusted free cash flow. If the SEC allowed them to present that on a per-share basis, the headline might read, "We generated $2 of adjusted free cash flow per share."
Okay. And as an intermediate investor, I see that and think, amazing. The stock is $20. They made $2 a share in cash. That's a 10% cash yield. They could pay me a massive dividend tomorrow.
Right. It sounds like a fantastic, secure investment.
Right.
But it's an absolute illusion because that adjusted free cash flow metric might be completely ignoring mandatory debt service. It might be ignoring mandatory capital expenditures required just to keep the lights on. The company might legally owe all of that cash to bondholders. They don't actually have $2 per share to give to you.
Wow.
By forbidding the presentation on a per-share basis, the SEC stops management from tricking retail investors into thinking there's a massive pool of cash waiting to be distributed, when in reality, the company is up to its eyeballs in non-discretionary commitments.
That is brilliant. It just stops the illusion of a dividend right in its tracks. And, the SEC isn't just resting on rules from 2003, are they?
No, absolutely not.
Because management teams, they get creative, they find loopholes, and the SEC has to respond. The sources actually point to a massive regulatory update that just happened recently.
Yes. The dynamic is a constant game of cat and mouse. A huge milestone in this ongoing battle occurred in December 2022. The SEC issued updated compliance and disclosure interpretations, commonly referred to as C&DI updates.
Okay, C&DI. What prompted this?
The SEC had noticed a really disturbing trend. Companies were increasingly cherry-picking their adjustments to inflate earnings. And in December 2022, the SEC cracked down hard.
Cherry-picking how? What exactly were companies doing?
The SEC specifically targeted the practice of companies excluding normal, cash-settled, recurring operating expenses. Management teams were taking the everyday costs of running their business, labeling them unusual or non-recurring, and just backing them out of their earnings.
They just pretended it didn't happen.
Basically. The SEC firmly stated that an operating expense is considered recurring if it occurs repeatedly or occasionally, even at irregular intervals.
Give me a concrete example of this. What kind of expense are we talking about here?
Think about a massive retail chain. Part of their core business model is expanding into new markets and closing underperforming locations.
Right, opening and closing stores.
Right, so opening new stores and terminating the leases on failed stores. That is a normal, expected part of operations. But retail companies were taking those lease termination fees and the legal costs of opening new stores, and they were adding them back to their non-GAAP earnings, calling them one-time restructuring costs.
So they were basically telling investors, hey, if you ignore the cost of opening and closing our stores, our retail business is booming.
Exactly.
But opening and closing stores is the business.
That is exactly what the SEC said. They finally stepped in and said, stop pretending that the fundamental cost of doing your actual business is a one-time anomaly. If you are a retailer, lease terminations are a recurring operating expense. You cannot adjust them away.
I love that.
This C&DI update forced a massive wave of honesty back into the reconciliation bridges across the entire market.
Okay, well, speaking of fundamental costs that companies love to pretend don't exist, let's pivot. Because we need to talk about the elephant in the room. This is arguably the most heated, vicious debate in corporate finance today.
Oh, I know where you're going.
We have to talk about stock-based compensation. SBC.
Great distortion.
It really is. And I am going to push back hard here on behalf of every listener who owns a tech stock.
Do it. Let's hear the argument.
Because I read earnings transcripts from high-growth software companies all the time. And they exclude SBC from their adjusted earnings. Their CEOs, their CFOs, they argue, and very convincingly, I might add, that stock-based compensation is a non-cash expense.
Right.
They say, look, when we give a software engineer $100,000 worth of restricted stock units, RSUs, it doesn't deplete our bank account. It doesn't consume working capital today. Therefore, they argue, it shouldn't impact our view of the company's free cash flow or its core operational efficiency.
It sounds perfectly logical.
It does, honestly. It makes sense. Are they right?
For the intermediate investor who is trying to build sustainable, multi-decade wealth, that argument must be completely dismantled and thrown out the window.
Okay.
It is a highly seductive narrative. It sounds logical, but it is fundamentally economically flawed.
All right, dismantle it for me. I'm open to having my mind changed. Why is excluding a non-cash expense a problem? If no cash leaves the vault, why should I care?
You should care, because while stock-based compensation does not consume working capital today, it massively dilutes your ownership stake in the future. Excluding it ignores a very real, tangible economic cost of labor. Let's break down the mechanics.
Okay.
Under strict GAAP rules, companies are required to record SBC as a non-cash operating expense. They have to calculate the fair value of those equity awards, the options or the RSUs, and they have to allocate that cost across their income statement into cost of goods sold, R&D, SG&A. It reduces GAAP net income significantly.
Right. And then management releases their adjusted numbers and says, hey, ignore that hit. It's just paper math.
But it is not just paper math. It is an economic transfer of wealth. Let me give you an analogy. Imagine you and I own a highly profitable pizza shop.
I love pizza. I'm in.
We each own exactly 50% of the business. We decide we need to hire a master chef to improve our recipe. The chef wants a salary of $100,000 a year.
Okay, standard business expense.
Right. Scenario A. We pay the chef $100,000 in cash from the register. Our cash flow drops, our profits drop, but you and I still own 50% of the business each.
Makes total sense.
Now, scenario B. We want to conserve our cash to buy a new oven. So instead of paying the chef in cash, we pay him $100,000 in equity. We print new shares of the pizza shop and hand them to the chef.
Okay.
Management, the guys running the non-GAAP playbook, would look at scenario B and say, amazing, we paid the chef, but our cash flow didn't drop. Add that $100,000 back to our adjusted EBITDA. We are incredibly profitable.
Wait, what happened to our ownership?
Exactly. We printed new shares. We expanded the pie. So now you don't own 50% of the pizza shop anymore. You own 45%. I own 45%. And the chef owns 10%. You own a smaller percentage of all future pizzas sold, all future cash flows, and the eventual sale price of the business. Management wants you to focus entirely on the fact that the cash register is full, while completely ignoring the fact that they are slowly giving away the keys to the building.
Wow. When you put it like that, it's basically a hidden tax on the shareholder.
It is.
You are artificially inflating the profit in the numerator while simultaneously hiding the fact that the pie in the denominator is being sliced into millions of extra pieces.
Precisely.
So how do the pros handle this? If institutional allocators are looking at both GAAP and non-GAAP, how do they reconcile the SBC problem in their models? Do they just add it back?
They do not let management get away with the illusion. Institutional analysts use a specific mathematical model called the treasury stock method.
Okay, the treasury stock method. That sounds like textbook jargon. If I'm an investor looking at a 10K, how does that math actually work in practice?
The treasury stock method is a way to calculate the true, fully diluted share count. It forces reality back into the equation. It assumes that all in-the-money stock options and unvested RSUs are fully exercised.
Okay.
It then assumes that the company uses any hypothetical cash proceeds from those exercises to buy back shares on the open market. The net result is a highly accurate expanded share count.
Okay, so find the true number of slices in the pie.
Yes. And here is the absolute golden rule for modeling. If you are going to let management exclude SBC from the net income numerator to calculate an adjusted EPS, you must use the treasury stock method to account for the massively increased share count in the denominator.
No.
If you ignore the expense at the top, but fail to adjust the share count at the bottom, your valuation multiples, your adjusted PE ratio, your EV to EBITDA, they are fundamentally broken and completely useless.
Because you're comparing two totally different realities. A fake profit against a fake share count.
Precisely. And this distortion is glaring when you compare competitors.
Give me an example.
Imagine Company A, an older tech firm. They pay their employees entirely in cash. Company B, a new startup, pays its employees heavily in stock. If they have the exact same operational efficiency and the exact same revenue, Company B will report a massively higher adjusted free cash flow simply because they are adding back their payroll cost.
But they're diluting their shareholder base 5% a year to achieve that illusion.
Exactly. Which is why the sources point out that mature, high-integrity companies, and they specifically name Microsoft and Netflix here, treat equity awards as the real operating costs they are. They do not try to hide them in their primary non-GAAP metrics.
Right. They acknowledge that labor has a structural cost, whether it's paid in cold hard cash or in equity. Ignoring SBC presents an incomplete picture of total labor costs, and that is a structural reality the retail crowd often ignores when they're buying high-growth stocks at these nosebleed valuations.
It's a huge blind spot.
This is exactly the kind of deep nuance we need. Theory is great, right? But real-world data is where the money is actually made or lost.
Absolutely.
We need to see this in action. So let's move into our case studies. We are going to examine real companies and look at how these non-GAAP metrics mislead. And also, to be fair and objective, how they sometimes actually provide clarity.
Because it's not always malicious.
Right. Let's start with a really fascinating anomaly, Dollar Tree. Specifically, their Q1 fiscal 2025 results.
Dollar Tree is a phenomenal starting point because it completely flips the usual cynical narrative right on its head. As we've discussed, non-GAAP earnings are almost always higher than GAAP earnings.
Upward bias.
Management uses adjustments to make themselves look better. But in Q1 2025, Dollar Tree did the exact opposite.
Okay, I'm looking at the numbers from the source material right now.
Yeah.
Their GAAP diluted earnings per share, the official audited number was $1.47.
Right.
But the adjusted non-GAAP EPS that management presented to the street was significantly lower. It was $1.26. Why would management deliberately put out a press release that makes them look less profitable? What's the incentive there?
To understand the motivation, we have to do what every serious capital allocator must do. We have to deconstruct the reconciliation bridge line by line. Let's look at the absolute dollars. Dollar Tree reported a massive GAAP net income of $313.5 million.
Okay, I am going to write this down. If you're listening, visualize the math with us or pull up a notepad. We're starting with the big number, the GAAP net income of $313.5 million.
Correct. Now, we look at the reconciliation table. The first adjustment management makes is a $61.8 million non-operating insurance gain.
Okay, let's pause. This is a gain. This is money coming in.
Yes.
It was included in that $313 million NAP number. So to get to the core operating number, management is actually subtracting it.
Exactly. So $313.5 million minus the $61.8 million insurance windfall brings us down to $251.7 million.
Got it. I'm following the math. 251.7. But wait, you said the final non-GAAP net income they reported. I have it here as $269.7 million.
Right.
We are at 251.7. There is an $18 million gap there. Where does that come from?
That $18 million gap is the second adjustment on the bridge. Management identified strategic review costs.
Okay.
Because these were expenses money going out that reduced the original gap number, we have to add them back to see the core performance without them.
Oh, I see. So we take our running total of $251.7 million. We add back exactly $18.0 million in strategic review costs, and boom. We land perfectly on the $269.7 million non-GAAP adjusted net income.
You've just audited the bridge. The full equation is GAAP net income of $313.5 minus the insurance gain of $61.8 plus the strategic review costs of $18 equals the non-GAAP adjusted net income of $269.7.
It's literally like finding a winning lottery ticket. Basically, Dollar Tree found a $60 million winning scratch-off ticket on the floor of the store. Under GAAP, they have to claim that as income. But management is honest enough to say, hey, investors, don't expect us to find a winning scratch-off ticket every quarter. Let's back that out of our performance metrics so you don't overestimate our future earning power.
That is a perfect analogy. The insurance payout likely stemmed from a damaged distribution center or maybe a settled lawsuit. It is a one-time windfall. It tells you absolutely nothing about how good Dollar Tree is at sourcing and selling discount merchandise at a margin.
Right.
If they left it in the headline number, lazy analysts would extrapolate that high profitability into the future and the stock would become overvalued. By stripping out the $61.8 million gain and adding back the $18 million in one-time consultant fees for a strategic review, management is providing extreme clarity.
They're isolating the engine again.
They're saying, look, ignore the noise. This $269.7 million is the true, repeatable underlying power of our retail engine.
That is a brilliant example of non-GAAP functioning exactly as it was intended.
Right.
It provides clarity. It's the check engine light and the speedometer working together.
Yes.
But, we wouldn't be doing our jobs if we stopped there. Let's look at a company where the GAAP might be masking something significant, a situation where the Photoshop listing is doing a lot of heavy lifting. Let's talk about Salesforce and the phenomenon the sources call the margin illusion.
Salesforce is the archetypal example of a highly successful, mature software enterprise that maintains a massive structural gap between its GAAP reality and its non-GAAP presentation. And this gap is driven almost entirely by our old friend, stock-based compensation, alongside another accounting mechanism called the amortization of acquired intangible assets.
Let's analyze their fiscal year 2027 operating margin guidance.
Let's do it.
Okay, I have the forward guidance right here. Their guided GAAP operating margin is 20.9%, which I have to say, for a massive, mature SaaS company holding a 20% true GAAP operating margin, that's a very solid, healthy business.
It is an excellent GAAP margin. It shows a highly profitable enterprise. But in their presentations to Wall Street, they are heavily touting a non-GAAP operating margin of 34.3%.
That is a staggering difference. We are jumping from 20.9% to 34.3%. That completely changes the valuation profile of the company. How on earth do they bridge a 13-point gap in margin?
When you deconstruct their bridge, the math is illuminating. The biggest single driver of that inflation is a massive 9.0 percentage point adjustment exclusively for stock-based compensation.
Wow, 9%.
Yes.
So they take a 21% margin, add back the cost of paying their developers, their salespeople, their executives in stock, and suddenly they have a 30% margin.
Exactly. Now, to be comprehensive, they also add back 4.1% for the amortization of purchased intangibles and another 0.3% for restructuring.
Okay, wait, let's clarify that for the listener. What exactly is the amortization of purchased intangibles? That sounds like something a lawyer invented just to confuse people.
It's actually a very straightforward concept. Salesforce is famous for growing through massive acquisitions, buying companies like Slack, Tableau, MuleSoft. When you buy a software company, you aren't really buying physical factories or inventory.
Right, there's no physical stuff.
You are buying intangible assets, their customer lists, their proprietary code, their brand name, and a premium called goodwill. Under GAAP accounting, you cannot just write off that massive purchase price on day one. You have to slowly expense the cost of those intangible assets over time, usually over several years. That slow expensing is called amortization.
Okay, so it's a non-cash accounting charge reflecting the money they spent years ago to buy Slack.
Yes. And many analysts agree that adding back amortization makes sense because it is a sunk cost that distorts current cash flow generation. The real controversy, the structural issue, is that 9% adjustment for stock-based compensation.
Right, because unlike amortization of past purchases, SBC is an ongoing active transfer of wealth every single quarter.
Precisely. Investors who anchor their valuation models solely on that 34.3% non-GAAP margin are falling victim to the margin illusion. They are modeling the cash flow of a company that operates at a 34% margin while completely ignoring the incredibly dilutive costs of the equity programs required to retain top-tier engineering talent in Silicon Valley.
And that talent isn't cheap.
No. That 9% difference represents a real economic transfer of wealth from existing public shareholders directly into the pockets of employees. It is not free, and if you ignore it, you will consistently overpay for the stock.
That is a crucial warning for anyone holding large cap tech. You have to adjust the denominator.
Always.
But, this raises a counter question. Is the GAAP appraisal always the most accurate reflection of the business in the moment? Are there times when GAAP is actually the deceptive metric? Let's talk about Uber Technologies, because their accounting history is incredibly noisy.
If we connect Uber's financials to the broader regulatory picture, it perfectly demonstrates a systemic flaw, or at least a massive vulnerability in the rigid GAAP framework. Specifically, the artificial volatility introduced by mark-to-market accounting rules.
Okay, break down mark-to-market for me. How does that impact a company that just drives people around and delivers food?
Well, Uber is not just an operating business. They also act somewhat like a venture capital fund. Over the years, they have acquired massive minority equity stakes in other global ride-hailing and mobility companies. They own a significant piece of Didi in China, Grab in Southeast Asia, Joby Aviation, Aurora.
Okay, so they own billions of dollars in stock of other public companies.
Yes. And under GAAP rules, if a company holds publicly traded equity investments, they must adjust the value of those investments on their balance sheet to match the current stock market price at the end of every single quarter. This is marking it to the market.
Okay.
Furthermore, GAAP requires them to take the difference, the unrealized paper gains or losses, and run them directly through their primary income statement.
Hold on. Let me make sure I understand this. So if the Chinese stock market crashes and the value of Didi plummets, Uber's official income statement takes a massive hit, even if their own core business people, taking Ubers in New York and London, is booming and generating record cash.
Precisely. The volatility of the broader stock market infects their operational income statement. Let's look at the data from Q1 2022. It is a textbook example. In that quarter, Uber posted a catastrophic GAAP net loss of $5.93 billion.
Almost $6 billion in a single quarter. That sounds like a company actively going bankrupt.
It looks terrifying on the surface. But when you apply your toolkit and deconstruct the bridge, you discover that $5.6 billion of that massive loss was simply a pre-tax write-down of their equity investments. The global stock market had a bad quarter, so Uber had to take a $5.6 billion paper loss. Their actual core ride-hailing and delivery business didn't lose $6 billion. In fact, their core non-GAAP adjusted EBITDA for that exact same quarter was a positive $168 million.
Wow. So if you were a stubborn GAAP purist and you just flat out refused to look at the non-GAAP reconciliation, You would look at that almost $6 billion loss, panic, sell all your stock at the absolute bottom, and completely miss the fact that the underlying operating business had finally turned cash flow positive to the tune of $168 million.
Exactly. You would have been shaken out of a good position by an accounting quirk. And the reverse is equally true, by the way.
Oh, really?
Yeah. In Q4 2021, the quarter just prior, Uber reported a GAAP net income of $892 million. The headline looked like they were printing money, but that included a massive $1.4 billion unrealized equity gain because the market was up. Their core operating adjusted EBITDA was actually only $86 million.
Wow.
So in Uber's specific case, the non-GAAP metrics are absolutely essential. You have to strip out the mark-to-market paper volatility to see the true trajectory of the underlying mobility business.
So it truly is a double-edged sword. You have to know why the gap exists. You can't just blindly trust GAAP, and you certainly can't blindly trust non-GAAP.
You need both ledgers.
Okay, let's shift gears and have some fun with this.
Yeah.
We've looked at the nuanced cases, the Dollar Trees, the Ubers. Now let's enter the danger zones.
The fun stuff.
These are the case studies pulled from our sources that highlight the most egregious, aggressive, and sometimes borderline fraudulent abuses of non-GAAP metrics. These are the red flags that every listener needs to permanently burn into their memory. Let's start with the absolute granddaddy of financial engineering, WeWork.
WeWork, the absolute extreme limit of corporate hubris and financial distortion. This case study is legendary. Prior to their spectacularly failed IPO attempt in 2019, WeWork introduced a bespoke metric to the bond market that they proudly called community-adjusted EBITDA.
Community-adjusted EBITDA. Just want to pause and savor the absolute absurdity of that phrase. Community-adjusted. What on earth were they adjusting? The vibe.
To understand the audacity of this metric, you have to look at the mechanics of what they excluded. To calculate community-adjusted EBITDA, WeWork started with their massive GAAP net loss, which in 2018 was nearly $1 billion, $933 million to be exact.
Okay.
They added back the standard items, interest, taxes, depreciation, and amortization.
No.
That gets you to a normal EBITDA.
Okay, fine. Standard procedure so far. Everyone does that.
But then they kept going. They proceeded to add back lease costs for buildings that weren't fully occupied yet. They added back building-level operating expenses like utility bills, internet access, and the salaries of the community staff who managed the buildings. And finally, they added back all of their sales, marketing, and general administrative expenses.
Wait. Let's ground this in reality. WeWork was fundamentally a commercial real estate subleasing business.
Yes.
Their entire model was rent a large building, chop it up into smaller desks, and rent those desks to freelancers and startups. And you're telling me they created a profitability metric that explicitly added back the cost of rent, utilities, and salaries?
Yes. They essentially took a scalpel, isolated the core, non-negotiable, recurring cash expenses of their entire business model, reclassified them as adjustments, and just removed them from the equation. By performing this accounting alchemy, they transformed a $933 million GAAP net loss into a community-adjusted EBITDA of a positive $233 million.
They presented a financial reality where a real estate company didn't have to pay rent. That's like a taxi driver claiming he's highly profitable as long as you ignore the cost of gas, the car payment, and his own salary.
Precisely. It was a metric completely and utterly divorced from economic reality. The institutional financial community looked at this filing, rightly criticized it as a delusional view of profitability, and the ensuing backlash was a major catalyst that destroyed investor confidence and collapsed their IPO.
Wow.
It stands as the ultimate warning of what happens when management is allowed to define their own reality.
That is insane. Okay, what about Groupon? The sources mentioned their pre-IPO phase back in 2011. They tried a similar trick, didn't they?
They did. Groupon introduced a highly aggressive metric called Adjusted Consolidated Segment Operating Income, or ACSOI.
ACSOI.
Catchy. They used this metric to adjust their standard GAAP operating income by excluding stock-based compensation, which is standard and acquisition costs. But the fatal flaw was that they also excluded all subscriber acquisition marketing expenses.
But they were a daily deal internet coupon company. Marketing, buying ads on Google and Facebook to get people to sign up for emails is literally the only way they get customers. It is their primary, ongoing, recurring cost of goods sold.
Exactly. But Groupon's management tried to spin a narrative. They argued that because a customer might stick around and buy coupons for years, the initial marketing cost to acquire that customer should be viewed as a one-time capital investment to build an asset, not a recurring daily operating expense. So they just erased the cost of customer acquisition from the income statement.
And what was the mathematical result of that erasure? Let me guess. Huge profits.
It was miraculous. By erasing their biggest expense, they turned a 2010 GAAP operating loss of $420 million into an ACSOI of positive $60.5 million. They tried to go public on that narrative, but this time, the SEC intervened forcefully.
Good.
They issued severe comment letters challenging this exclusion, citing violations of Regulation G. They argued that marketing is a normal recurring operating expense for an internet commerce company. Groupon eventually had to back down, abandon the metric, and restate their filings to reflect economic reality.
Okay, let's escalate this. Because WeWork and Groupon were pre-IPO companies trying to spin a narrative to get out the door. Let's look at a massive public company where the manipulation resulted in actual SEC charges and massive financial penalties. Valeant Pharmaceuticals.
Valeant, which was later forced to rebrand as Bausch Health after the scandal, is a dark case study in how non-GAAP metrics can be used not just to spin, but to actively deceive the market about severe operational decay. The SEC formally charged the company and 3 top executives, resulting in a $45 million penalty. There were 2 massive, highly coordinated structural deceptions here. First, let's look at the Philidor channel.
Set the stage for us. What was the narrative Valeant was selling to Wall Street at the time?
In 2014 and 2015, Valeant was an absolute darling of the hedge fund world because they touted incredible, consistent, double-digit organic growth. They claimed organic growth hit 22% in Q3 2015.
And just to clarify for the listener, organic growth is supposed to be the holy grail, right? It means sales generated from the businesses you've owned for at least a year, stripping out the artificial boost from newly acquired companies. It proves your core products are actually gaining market share.
Exactly. It proves the underlying business is healthy. But the SEC investigation revealed that a huge portion of this organic growth was entirely fabricated. It was driven by massive sales to a company called Philidor. Philidor was a mail-order pharmacy network.
Okay.
What Valeant hid from investors was that they had secretly helped establish Philidor, they provided the funding for it, and they heavily subsidized its operations. Furthermore, Valeant was prematurely recognizing revenue on massive shipments of drugs to Philidor, even though the drugs hadn't actually been sold to end patients yet. It was a classic channel stuffing scheme, facilitated through a secret captive entity.
So they were basically backing trucks up, selling drugs to themselves, recognizing the revenue, and calling it 22% organic growth. What would the real number have been?
The SEC determined that if you backed out the fraudulent Philidor sales, Valeant's true organic growth for that quarter would have plummeted from the touted 22% down to just 7%. They were masking a collapsing core business.
That is fraud. Straight up. What was the second issue? The sources mentioned a drug called Glumetza and a massive price hike.
This is a masterclass in metric manipulation designed to fool algorithmic models and analysts. In Q2 2015, Valeant acquired a diabetes drug called Glumetza. Immediately upon taking control, they executed an astronomical 500% price increase overnight.
500%.
Yes. This aggressive price gouging generated an immediate windfall of $110 million in price appreciation credits from wholesale distributors. Now, under standard tracking, all of that $110 million should have been attributed to the Glumetza product line. But Valeant's executives knew that if they did that, analysts would instantly recognize it as a one-time unsustainable price gouge. They would discount it in their models.
So how do they hide it?
In their internal accounting and their external non-GAAP presentations, management systematically took that $110 million windfall and spread it across more than 100 completely unrelated products in their portfolio.
You have to be kidding me. Why?
Because by spreading it out, they artificially inflated the non-GAAP product-level growth metrics across their entire company. Suddenly, 100 different drugs looked like they were experiencing healthy, steady, mid-single-digit organic growth. It misled every single analyst who was building a discounted cash flow model to project the sustainability of Valeant's pipeline. It made the entire enterprise look like a steadily growing machine rather than a company relying on toxic, unsustainable price hikes on acquired drugs.
That is incredibly deceptive. They actively poisoned the data pool that the analysts were drinking from. Now, the sources mention one more major danger zone, and this one is vital because it shifts our focus. Everything we've discussed so far, WeWork, Groupon, Valent, is about manipulating the income statement, making profits look higher. But this last case study is about the balance sheet. Silicon Valley Bank, SVB.
The total collapse of Silicon Valley Bank in March 2023 is a terrifying, historic example of how bespoke alternative metrics can mask systemic, fatal balance sheet risks until it is far too late. To understand SVB, we have to do a really quick primer on bank accounting.
Let's do it. Walk us through the mechanics.
A bank's balance sheet is an inversion of a normal company. For a bank, your deposits, the money you put in your checking account, those are liabilities. The bank owes you that money. To make a profit, the bank takes your deposits and buys assets, typically loans or government bonds that pay interest.
Okay.
Under GAAP, banks must categorize their bond portfolios into two main buckets: available for sale, or AFS, and held to maturity, or HTM.
Okay, available for sale and held to maturity. What is the difference in how they are accounted for?
It's all about mark to market. If a bond is categorized as available for sale, it must be marked to market. If interest rates go up, the value of the bond goes down, and the bank must recognize those unrealized paper losses on their balance sheet, which directly reduces their reported GAAP equity capital.
But what about held to maturity?
This is the GAAP loophole. If management declares that they have the intent and ability to hold a bond until it matures in 10 or 20 years, they put it in the HTM bucket. Under GAAP, HTM bonds are not marked to market on the primary balance sheet.
Really?
Yeah. The assumption is, if you hold the U.S. Treasury bond to maturity, Uncle Sam will give you your principal back, so the day-to-day price swings don't matter. The unrealized losses are hidden in the footnotes, but they don't impact the headline equity metrics.
Okay, so SVB dumped a massive amount of their deposits into these long-term HTM bonds right when interest rates were at rock bottom.
Yes. They bought tens of billions of dollars of low-yielding, long-duration mortgage-backed securities. Then the Federal Reserve started rapidly raising interest rates in 2022. As new bonds paid higher yields, the value of SVB's old, low-yielding bonds plummeted. They were sitting on massive, multi-billion-dollar unrealized losses in their HTM portfolio.
But because of the GAAP rule, those losses weren't crushing their official capital ratios.
Correct. But here's where the non-GAAP deception comes in. SVB wasn't content just hiding behind GAAP. They actively promoted a bespoke non-GAAP measure called the economic value of equity, or EVE. In their 2021 10K filings, they used this EVE metric to model what would happen if interest rates rose.
And what did their custom metrics say?
The EVE metric selectively modeled the benefits of rising rates. It argued that if rates rose, the bank wouldn't have to pay depositors as much relative to the market, which is incredibly valuable. So the EVE metric added a massive $4.1 billion favorable adjustment to their equity. They presented a non-GAAP economic value of equity that was 25% higher than their GAAP equity. They told the market, look how strong we are.
Let me guess. They added the $4.1 billion benefit, but they completely ignored the other side of the equation.
Exactly. This EVE metric completely and deliberately excluded the catastrophic, unfavorable impact of the unrealized net losses on their massive HTM debt portfolio. They modeled the upside of rising rates and ignored the downside. By the end of 2022, as interest rates surged, the unrealized losses on those HTM bonds grew so massive that they effectively wiped out 93% of the bank's actual tangible equity value.
93% of the bank was effectively gone, mathematically speaking.
Yes. But because management selectively presented a highly favorable non-GAAP metric that highlighted asset strength while completely ignoring the unfavorable real-world interest rate duration risk on the liabilities, investors and depositors were lulled into a false sense of security. They looked at the non-GAAP economic value of equity, thought the bank was highly capitalized and conservatively managed, and completely missed the fatal rot on the balance sheet.
Unbelievable.
When depositors finally woke up and started demanding their cash back, SVB had to sell those HTM bonds at massive losses to generate liquidity. The illusion shattered, the bank became technically insolvent, and a historic bank run ensued.
They looked at the Photoshop listing of a fortress and missed the fact that 93% of the foundation had crumbled into dust. That is absolutely chilling. And the scary part is, we see variations of this behavior across the entire market constantly.
It's everywhere.
The source material lists a barrage of examples. We see cybersecurity giant CrowdStrike leading their earnings calls with annual recurring revenue, or ARR. ARR is a metric that assumes a 100% customer renewal rate, projecting a reality that can be 3.2 times higher than the actual GAAP revenue they've legally recognized.
We see legacy telecom companies like Vonage attempting to exclude massive marketing and shipping expenses as pre-marketing operating income, trying to recreate the Groupon illusion.
We see financial firms like BGC Partners executing an accounting sleight of hand, excluding massive expenses from their pre-tax earnings to inflate the top line, but then hypocritically claiming those exact same expenses for tax deductions to inflate their post-tax distributable earnings. They want the benefit on both sides of the ledger.
We even see smaller microcap companies like Swisher Hygiene and Cabela's engaging in outright GAAP violations, manually overwriting accounting entries just to hit the exact non-GAAP targets they promise Wall Street analysts. It is a systemic issue, which is exactly why every single investor listening to this needs a rigid toolkit to defend themselves. You cannot rely on the press release.
Exactly. This is where the rubber meets the road. Let's move into our final and most actionable segment, the Capital Allocators Toolkit. We need to arm our listeners right now. Let's start with the immediate warning signs. Detail the 3 major red flags to watch for the second you open a non-GAAP earnings release.
Red flag number 1, inconsistent adjustments. You need to vigilantly watch for companies that suddenly change their definition of adjusted EBITDA or non-GAAP net income quarter to quarter without proactively restating prior periods.
So changing the rules mid-game.
Exactly. If a company hits a bad quarter and suddenly they introduce a brand new adjustment category, say, excluding supply chain disruption costs that they never excluded before, that is a massive red flag regarding earnings quality. They are actively moving the goalposts in real time just to ensure they hit the consensus estimate.
It's like changing the rules of the game in the fourth quarter because you're losing. Got it. Red flag number 2.
Red flag number 2. Excluding recurring core operations, this is the WeWork and the Groupon warning label. If a company tries to add back marketing, customer acquisition costs, shipping, rent, basic tenancy costs, or standard legal compliance fees as adjustments, you need to run away.
Bad.
These are not one-time anomalies. They are the fundamental structural costs of operating that specific business model. If you can't be profitable while paying rent, you don't have a viable business.
And red flag number 3.
Red flag number 3. Pre-tax and post-tax mismatches. This is exactly what the SEC BGC partner is doing. You have to ensure that the reconciling items in the bridge are evaluated on a consistent after-tax basis. Watch out for corporate slide decks that mix pre-tax adjustments with post-tax GAAP metrics. It is an accounting sleight of hand designed to artificially inflate reported earnings by ignoring the tax burden associated with the core operations.
Okay, those are the 3 red flags. Inconsistent adjustments, excluding recurring ops, and tax mismatches. Now, let's give the listeners the concrete step-by-step checklist. I want to role-play this to make it highly practical.
Let's do it.
Let's say it's Saturday morning. I have a cup of coffee. I am opening my brokerage app right now, and I want to audit my biggest equity holding. Let's say it's a mid-cap software company. What is the literal first step I take?
Step 1, deconstruct the bridge. Do not look at the headline of the press release. Scroll past the CEO's glowing commentary. Find the tabular reconciliation table at the bottom of the document. Trace every single adjusted metric backward to its GAAP equivalent. Question the economic rationale of every single add-back. Ask yourself critically, is this truly a one-time unforeseen event like a factory fire? Or is management just trying to hide the cost of a bad strategic decision? If they're adding back restructuring costs every single year for 5 years, it's not a restructuring, it's just a poorly run business.
Step 2. I'm looking at my tech stock and they exclude stock-based compensation. What do I do?
Step 2, reincorporate stock-based compensation. If you own growth companies, especially in the technology sector, you must manually factor SBC back into your operational cost models. Do not use management's adjusted EBITDA margin if it strips out SBC. It's a fake margin. And critically, when you are evaluating valuation multiples, like calculating the price-to-earnings ratio or the free cash flow yield, you must use the treasury stock method to adjust the share count denominator. You have to model the dilutive impact of ongoing equity grants. If the share count is growing by 4% a year, your target return needs to be 4% higher just to break even on an ownership basis.
Step 3. I've fixed the SBC. What's next?
Step 3. Verify longitudinal consistency. Do not just look at this quarter. Pull up the 10K annual reports from 3 years ago, 2 years ago, and last year. Read the footnotes defining their non-GAAP metrics. Ensure management hasn't subtly, quietly altered how they calculate adjusted net income over time to smooth out bumpy operational performance. You are looking for a consistent yardstick. Step 4. Evaluate tax and cash alignment. This ties back to the red flag. Make sure that all reconciling items in the bridge are presented on an after-tax basis. You want to see the true bottom-line cash impact of these adjustments, not a pre-tax inflation of profitability.
And finally, step 5. Assess operational metrics versus GAAP reality. When evaluating SaaS, subscription models, or platform companies, you must cross-reference their forward-looking key performance indicators against the audited GAAP balance sheet. For example, if a company is touting massive growth in annual recurring revenue, ARR, you need to check the GAAP deferred revenue line item on the balance sheet.
Explain the connection there. What is deferred revenue? If a customer signs a 1-year software contract and pays up front, GAAP doesn't let you recognize all that cash as revenue today. You have to defer it and recognize it slowly over the 12 months as you provide the service. That's deferred revenue. ARR is management's projection of the annualized value of that contract, assuming the customer renews. So if management says ARR is growing at 50%, but the audited GAAP deferred revenue on the balance sheet is flatlining, there is a massive disconnect. It means they are projecting future growth that isn't backed up by actual cash commitments today. You need to investigate that gap immediately.
That is an incredibly powerful professional-grade checklist. Deconstruct the bridge, reincorporate SBC using the treasury stock method, verify longitudinal consistency across 10Ks, align the tax impacts, and cross-reference operational KPIs with GAAP balance sheet reality. If you apply those 5 steps to your portfolio this weekend, you are instantly operating at a higher level of financial literacy than 90% of retail investors in the market.
It is the only mathematical way to build a sustainable, accurate model of a company's true long-term earning power.
Okay. We are coming to the end of this deep dive. Let's summarize the core, overriding lesson of everything we've unpacked today.
The overarching principle that must govern your analysis is this. GAAP is the unshakable anchor of financial discipline. Non-GAAP is management's subjective narrative. You cannot rely purely on adjusted metrics because that is a recipe for disaster. You will fall victim to margin illusions, hidden dilution, and balance sheet rot. But paradoxically, you cannot entirely ignore non-GAAP either. Because as we saw with the Uber case study and the factory shutdown example, a rigid, inflexible adherence to GAAP might blind you to actual core operating trajectories masked by mark-to-market paper volatility or genuine one-time structural shifts. Sustainable wealth building requires understanding the tension, the push and pull between both sides of this bifurcated ledger.
It's exactly like the analogy. You have to read the brutal appraisal to know the foundation is cracked, but you also have to look at the listing photos to understand what the house could be if you fix the roof. You need both perspectives to navigate successfully and find intrinsic value.
Exactly. Of course, synthesis.
Before we sign off, I want to leave our listeners with a final provocative thought. Something to mull over on your commute or while you're looking at your portfolio this week, building on the structural issues we've discussed.
I want you to consider the macroeconomic implications of this massive reporting gap we've identified. As modern financial markets become increasingly complex, and as algorithmic, high-frequency trading dominates daily volume trading based on headline numbers and scraped data, we have to ask ourselves a systemic question. Will the widening gap between audited GAAP reality and bespoke non-GAAP optimism eventually trigger the next massive market correction? We noted right at the start that standard accounting and corporate narratives diverged by hundreds of billions of dollars annually in the S&P 500 alone. If a true, deep economic recession hits and the credit markets freeze up, the market will suddenly stop accepting adjusted promises. It will demand hard, GAAP-verified, distributable cash flows. And when that paradigm shift happens, that $250 billion gap is going to violently collapse. And when it does, you have to ask yourself, who is ultimately left holding the bag?
That is a terrifying but absolutely necessary question. Are you holding the bag of adjusted promises, or are you holding the reality of audited cash flows? Think deeply about that as you audit your portfolios using the toolkit this week. Remember, usually when we talk about engineering, there's an expectation of absolute precision. You look at the blueprint, and the load-bearing wall is right there. The math is binary. But in the world of corporate financial statements, that blueprint is murky, subjective, and highly negotiated. It's up to you, the investor, to spot the structural realities the crowd is ignoring. Thank you for joining us on this intensive deep dive on the Technical Intrinsic Value podcast. We will see you next time.
That's it for today. I'll see you in the next episode. The Technical Intrinsic Value Podcast is a systematic explanatory to enhance data analysis and delivery. All content logics provided herein are a direct reflection of the opinions value model Nicolau Primavera Carvalho. The information provided is for educational and informational purpose only and does not constitute financial, investment, or legal advice. The TIV model is a framework designed to identify patterns based on 15 years of future results. All investments involve risk. By continuing, you acknowledge you are a self-reliant investor responsible for your own execution.